This is Business Weekend with Edward Boyd.
Hello and welcome to Business Weekend. I'm Edward Boyd. Coming up, sticky inflation in Australia is presenting a challenge for the Albanese government ahead of its third federal budget. The most recent forecast had the government posting a $1.1 billion deficit, but S&P Global Ratings analyst Anthony Walker believes the budget will be a lot better than expected.
We think the government will be conservative. They'll announce a small surplus. We think the surplus could be as high as $20 billion, which is in line with last year's.
After nearly 3 years of intense remediation and a clean-out of the board and management team, Crown Sydney has been handed back its casino licence by the New South Wales casino regulator. NICC Chief Commissioner Philip Crawford will explain why.
And there was an impressive urgency around those people that were left to pick up the pieces at the Crown after the Bergen findings were released.
Plus, the Department of Transport has begun calling for feedback from Australians on a new set of road rules designed to eventually allow driverless cars or autonomous vehicles on our roads. So, what are the challenges?
Consumers are waiting for these vehicles to come, but we also need to keep in mind that it's not a straightforward process.
All of that and more coming up on today's program. But first, inflation in the March quarter accelerated to a higher than expected 1% this week, surprising economists and the stock market.
I think today's number was a bit of a shocker, really. So came in at 1% quarter on quarter. The market was expecting 0.8%.
During the first 3 months of 2024, rents grew at their fastest pace since 2009, and education fees recorded their strongest rise since 2012. At an annualised rate, inflation decreased from 4.1% in December down to 3.6% at the end of March. Treasurer Jim Chalmers tried to downplay the significance of the sticky inflation figures on Wednesday.
If you think about annual headline inflation, it's actually tracking still a little bit lower than the forecast that we released in the mid-year budget update towards the end of last year. And I think that is important perspective. If you look at those forecasts, they were expecting inflation to be around 3 3/4 at the end of the June quarter, so next quarter, and already we are at 3.6, substantially lower than 4.1 the quarter before. So an important bit of perspective.
The Reserve Bank is expecting inflation to fall to 3.3% by the end of June. To achieve that, inflation in the second quarter needs to be no higher than 0.5%, which is half of what it was in Q1. Plenty of economists have now pushed back their expectation for rate cuts this year, and some, like our regular guest Warren Hogan, think we could be hit with more rate rises.
The risk we face is if we don't address our inflation problems in a timely manner, we get what I call the 1988 syndrome. And that's that you get behind the game and you have to put rates up a lot. And of course, back then that was a 17% cash rate. We're not going to go anywhere near that in this era. But you know what I'm getting at here. It's you got to be ahead of it. And I think the RBA will be.
The other challenge for the RBA and the government is slowing economic growth from major trading partners overseas, including the US, which has just posted its weakest quarterly growth in nearly 2 years.
I think it's fair to say that the world has sort of been grinding along in low growth mode for a little while. The looming federal budget will need to strike the right balance between providing cost of living relief to Australians doing it tough and not loading up Aussie consumers and businesses with too much extra cash, which could trigger a spending spree in the September quarter, adding to inflation and causing the RBA to hike interest rates. From a fiscal perspective, Australia's credit rating remains AAA, which was affirmed by S&P Global Ratings in September last year. Joining me now is S&P credit analyst Anthony Walker. Anthony, thanks for your time. Federal budget is in just over 2 weeks. What do you see as the big fiscal challenges facing Australia right now?
Yeah, we're expecting quite strong fiscal outcomes to be announced. We think the government will be conservative. They'll announce a small surplus. We think the surplus could be as high as $20 billion, which is in line with last year's. So we think right now the fiscal challenges they're not that challenging right now for the next 12 months. Going ahead, though, as the economy slows, we will start seeing unemployment rise. That means that the government's tax takes will start to weaken compared to previous years. At the same time, we are seeing constant pushes from the community and households for government support. So we do think that this will be a peak in the outcomes, and then going forward in the next couple of years, we'll see the government potentially return to a small deficit.
Yeah, looking broadly at some of the big issues the government's facing, spending's on the way up, wage rises, weak productivity. Which of those do you think is one of the biggest concerns for them?
We think they're all of a concern. We do think that going forward, productivity is a big issue for the economy. We have seen for a number of years the economy underperforming government forecasts on this. We do know that the intergenerational report usually has productivity picking up, and that's going to save the day. But in reality, it's been very, very difficult to get productivity higher. In fact, the last couple of years, it's been very weak outcomes on productivity. On the wage front, while wages for the government are increasing their wage bill and their expenses, this is actually turning out good for the government when it comes to things like the tax take. We're seeing bracket creep pick up, we're seeing inflation in wages. That means personal income taxes are rising at a rapid rate, and that's great for a government's budget.
So you expect we could see a surplus around $20 billion coming up in just a couple of weeks?
Yeah, we don't think the government will say that, but we think when the outcomes come out in a few months' time, when you look at it, the first 8 months this year, the government's budget is tracking $10 billion better than last year, and last year they delivered a $22 billion surplus. So when you throw that together, you would be expecting something around the same amount if they keep their fiscal discipline.
Yeah, your most recent report affirming the AAA credit rating September last year, in that you mentioned really the strength of commodity prices and the strong employment market. And when you look at where things are at now, it seems pretty similar today as it was back in September.
Yeah, that's correct. Commodity prices, iron ore, for example, still $115 a tonne. Unemployment around the mid 3%. That's well below the forecast for the government. They had it around 4.25% by the end of this fiscal year. At the same time, they had iron ore prices coming down to $60 a tonne. So while things aren't as good as they were a year ago, these data points are still extremely good for a government's budget.
One thing the Treasurer's Jim Chalmers has spoken a bit about this week has been weakening growth around the world. And we saw some numbers on Friday morning from the US showing GDP there is now growing at its slowest rate in about 2 years. I mean, how big a challenge is this for Australia?
We think things are actually okay at the moment. Only about a month ago, we actually revised our global growth forecast from 2.8% to 3.2% globally. That included a very large revision for the US economy. So while things are slowing down compared to the last couple of years, that's expected. Interest rates around the world are significantly higher. Reserve banks are trying to pull back on demand and growth, and this is what's playing out. But at the same time, the US economy, for example, is still really resilient. We're seeing growth around 2.5%. So we revised that up 1% for this fiscal year, which is a massive increase in the world's biggest economy. When we look a bit broader, you look at China, we still have 4.5% growth. That's not great for the Chinese economy, but that's still not bad, and we haven't revised that down in the last 6 months. And then we look at India. India is a very important market for us. It's a developing market that we're entering into. That's still growing at around 7% for the next 3 or 4 years. So yes, things aren't as good as they were in the past, but we're coming off a very big post-COVID boom. Things are going back to normal now, and the global economy, despite a lot of geopolitical risks, is actually doing reasonably well.
And this week, domestically, we saw the March quarter inflation numbers come in a little bit hotter than expected. We know the federal budget is going to be giving tax breaks back to Australian people and businesses. Is there a bit of a risk that inflation could jump in the September quarter with a bit more cash going back into the hands of Aussies?
Yeah, and we're watching the budget for this, see whether there's actually new announcements as well. When the government did change the tax reforms, we actually put a note out at that stage saying we think they are going to be marginally more inflationary than the former government's policy. When you're giving tax cuts to high-income earners, they're going to save a lot of it. When you give it to low-income earners who are living day by day, they're going to spend it. So we actually do believe they'll be marginally more inflationary. By themselves, we don't think that will change the outlook. We do think that the outlook for inflation is still going to be a few years before the Reserve Bank gets it to target. We think it will be late 2025, if not early 2026, before they do it. So we do think that the last bit of inflation is going to be much harder to get rid of it than the actual beginning of this. And we've seen that globally. We've seen the US economy really stuck in the low to mid 3% inflation. And we think the Reserve Bank's facing similar challenges.
Now, just looking at some of the states, I know you were the first ratings agency to cut New South Wales from AAA down to AA plus back in 2020. New South Wales this year have now been stripped of billions of dollars in revenue from the GST carve-up. How tough a job does the New South Wales Treasurer have right now?
Yeah, this is another focus point for us this year, is that the government came in on the promise to turn things around. They did make a lot of big announcements last year, but losing roughly $12 billion of GST in their forecast, it wasn't actually money in their pocket, it was actually in their forecast. That is going to be a big headwind. So we are expecting to see that government have to increase its savings, to reduce its spending, to try and counter this loss of revenue. Now, this revenue may come back in a couple of years' time, but at the moment, what we're seeing is the New South Wales government is underperforming what we're thinking it should at a AA plus level.
Okay, and what about Victoria, rated AA stable? You're obviously based down there. Its budget's released next month. How tough is the debt situation that the Victorian government is facing at the moment?
Yeah, Victoria has had a massive ramp up in borrowing. We do forecast it to be about triple what it was pre-COVID in just a 4 or 5 year period. This has obviously weighed on the rating. We did lower it by 2 notches in one go from AAA. It was the first time we've ever done that to a subnational government. They are facing challenges. We've seen a massive cost escalation for one of the biggest roading projects in Victoria's history. We think there's more to come for that road. At the same time, they are saying to dig tunnels for the suburban rail loop. And there's been a lot of critical kind of opinions on that from the Auditor General, the Ombudsman, for example. So we're really keen on seeing how they deliver these kind of massive projects to budget. Interestingly enough, on the flip side of New South Wales' issue with losing $12 billion of GST, Victoria is gaining $3.5 billion this year. So that should actually be a really good injection to the Victorian government budget.
And then the other government that is the big beneficiary from GST, Western Australia, we've already recapped commodity prices, but you upgraded them to AAA roughly 2 years ago. What's the outlook like for WA?
The outlook for WA has been for a while and continues to be much better than peers. It is very strong fiscal outcomes. Iron ore, again, it's $115 a tonne. Most governments are facing or forecasting a $60 a tonne forecast. GST revenues are continuing to flow into WA. So we do think that WA is a clear outperformer, not just domestically. It's one of the strongest subnational governments we've seen in the world. And that's why it has been rated AAA, and that's why we think it will retain that AAA rating.
And Anthony, we've only got 30 seconds, but just broadly, how positive are you about the rest of this year for Australia's economy?
Yeah, we think that things will slow down. Obviously, with borders open and we've got a very big intake of migration, the high-level data when it comes to GDP will be quite strong. We are positive overall, but on a per capita basis, there are headwinds, and we expect these headwinds given the Reserve Bank has raised interest rates so high. So things are playing out as we expect, and the economy, like the US economy, has been very resilient and doing quite well.
Anthony Walker, S&P Credit Analyst, thanks for coming on the program today.
Thanks for having me, Ed.
And we'll be covering all those topics and more at our exclusive live event in June, Australia's Economic Outlook, an annual Sky News event held in collaboration with the Australian newspaper. It's back at Crown Sydney on Friday, June the 7th. Our headliner is Prime Minister Anthony Albanese, who will sit down with Sky News political editor Andrew Clennell for a full wrap-up of the May federal budget. For tickets, head to skynews.com.au/outlook. The price of the precious metal gold has accelerated since the 1st of March, gaining roughly 15% in value. Investors have flocked to the safe haven as geopolitical risks intensify around the world and central banks purchase more bullion. Ross Greenwood caught up with John Reid, senior market strategist at the World Gold Council, to understand what has been causing gold to do so well.
The most recent driver that we've seen, really since the 1st of March, has been speculative buying on the COMEX futures market in the United States, supported, I guess, by a bit of safe haven demand associated with Iran's attack on Israel. But that speculative buying on COMEX wouldn't have been able to happen if it hadn't had for 2 other major factors. Central bank purchases, which have been really strong since the middle of 2022, and then over the last few months, really strong retail demand for gold in China, both in jewellery, but especially in investment.
OK, let's go to China to begin with, because it's not just China. It seems as though they're wanting some sort of a hedge away from the US dollar. It's also India, it's also Turkey that have also been very strong purchasers at a central bank level of gold.
Sure, and the increase in central bank purchases we've seen over the last 2 years has been associated with what I describe as a soft de-dollarization, a move away by central banks from holding the vast majority of their reserves in US dollars towards a different mix. Now, that different mix in time will probably include the currencies of major emerging market powers like China, like India, etc. But those currencies aren't really ready yet for reserve currency status. So gold is acting as a decent proxy until they do. And why it's a good proxy is because, well, the International Monetary Fund recognizes gold as a central bank reserve asset. And also, gold demand is driven by the economies of these two countries, India and China, the second and largest consumer of gold. So that satisfies a lot of requirements, I think, for central banks that are beginning to slowly reduce the amount of US dollars in their portfolios.
OK, so the central banks are reducing the amount of dollars in their portfolios, but it seems also that even consumers are doing the same thing. Even in the United States, there's a move away from holding physical dollars to holding, as you say, as gold as a proxy for it.
Sure, although it is interesting that the strength we've seen in gold hasn't really been driven by Western buying over the last 12 months. And in fact, there's been a pretty big slowdown in the appetite from North American, well, US and Northern European buyers of physical coins and small investment bars. So this really has been an emerging market phenomena that's been driving gold over the last 2 years. And that's probably why gold has been able to ignore the typical drivers that would have been a headwind for it. The strength of the US dollar, high interest rates, the fact that the Fed is no longer expected to cut as much, maybe even at all, as it was a few months ago. Gold shrugged off all those factors and has continued to hit a series of new all-time highs.
And then take me to the supply side of gold. Is there any real suppression of the supply side? Given the fact, obviously, with gold prices being so strong, it makes a lot of mines that might have been otherwise questionable now become really decent prospects.
It certainly helped. There's no doubt that high gold prices have made marginal mines or marginal ore bodies within otherwise profitable mines able to be exploited. But to be honest, the gold price has been high for a couple of years. The gold mining industry has been doing pretty well. It's now just doing very well. So I don't see an enormous supply response coming from these higher gold prices, because I think the gold mines were pretty much accessing everything that they could already. And in terms of bringing new mines and projects on stream, the lead time on these is anything from 3 years to 15 years. So we'll only see the impact of these really strong prices starting to kick in a few years' time. We do expect gold production probably to break the all-time high this year, but that all-time high was set back in 2018. So I think the way I think about mine production is that it's been plateauing for the last 6 or 7 years and now has the potential, I guess, in the medium to longer term to expand if mining companies pull the trigger on some of these new projects that they've been considering.
So then you talked earlier about, the friction in the world, the geopolitical situation, Ukraine, Russia, the sanctions on Russia, but then also China, of course, and its relationship with the United States. I just wonder how much of this is safe haven buying by people in some of those countries that may have significant disputes with the United States, and as you point out, that US dollars probably aren't the thing to hold anymore.
Yeah, that's true. But I think also it often represents a choice by investors and savers in emerging markets to try and reduce their dependency on their own domestic currency. So if you're sitting in China at the moment, the property market, which is probably where you've made most of your investments, has been doing pretty poorly now for the last couple of years. The equity market isn't great. There's concerns that the Chinese currency will weaken further. Gold is a great alternative to holding RMB-denominated assets. And I think that's benefiting there. Certainly that was the case in Turkey that we saw last year, ahead of the profound depreciation we saw in the Turkish lira. People in Turkey wanted to own hard assets because they expected the currency to fall after the presidential election, which indeed it did. Gold benefited a lot. So I don't think it's always about the US dollar. It can often be about concerns about domestic currencies, particularly within emerging markets.
So just tell me, is there any correlation that I should read into record prices for gold prices and a similar significant climb for cryptocurrencies, and in particular Bitcoin?
I don't know. I think they're very different assets. Bitcoin has benefited from the enthusiasm towards the space following the listing of cash ETFs in the United States earlier this year. And we saw a very rapid increase in the price of Bitcoin after those instruments were launched. It seems to have stabilized a bit now at around $60,000, $65,000 a Bitcoin. And a lot of the excitement that was there around the beginning of the launch of these ETFs has gone away. I also think about crypto assets as immature in many respects. You know, we've only really had about 20 years of crypto assets, so people are still working out what to do with them, how to invest in them, getting comfortable with them. Gold is a mature asset, and it's fulfilled a role for thousands of years, and within the monetary system, certainly for hundreds of years. People understand what gold does and how to play it. And I think it's reacting to its traditional role as that of something which you want to hold during uncertain times. Now, those uncertainties can be driven by lots of factors, whether it's economics, whether it's geopolitics, whether it's even a pandemic, as we saw back in 2020. So the fact that gold and Bitcoin are going up at the same time, or have been going up at the same time this year, I don't read too much into it. They're very different assets.
I'll tell you what, John Reid, good to have you on the program. Really good to have you on the program and your insights. Many thanks for your time today.
Thank you very much.
Coming up after the break, Crown Sydney regained its New South Wales casino licence this week. So what did it do right, and what is the Star doing wrong? New South Wales casino regulator Philip Crawford will explain. Plus, the federal government is seeking feedback on new road rules which will eventually allow driverless cars onto our roads, but they could still be years away. Welcome back. This week, Crown Sydney regained its licence to operate a casino in New South Wales after nearly 3 years of intense remediation. The positive news for Crown comes at a time when its competitor in Sydney, the Star, is in a world of regulatory pain. So what has Crown done right that the Star can learn from? I spoke to New South Wales Independent Casino Commission Chief Commissioner Philip Crawford earlier this week.
Well, look, it's been a 3-year journey, and early on, they grabbed the opportunity. We had an obligation under the various contracts with government to work with them to see if we could find a way. Once they were found unsuitable, we couldn't just take the licence away. We were contractually bound to best endeavours to see if we could find a way forward for them to get back to suitability. And so those negotiations commenced pretty much straight away. And there was an impressive urgency around those people that were left to pick up the pieces at the Crown after the Bergen findings were released. Helen Coonan was there for a period, and she pretty much restructured their whole board and their whole senior executive team. Then some of the executives they got in realised that the morale of the staff was pretty low. They'd seen some pretty shocking things come out of the inquiry, and so they needed to get on with it pretty quickly and start addressing not only their operational issues but also their cultural issues. So they put the company on a good footing. But after that, we had agreements with them as to what we required, and it's been a really hard slog working with them to embed in their operations the internal control measures that we required, which go to almost every part of their business and how it should be operated. So very extensive process over the last 3 years.
So it sounds like the attitude from management changed, and when Blackstone took over, that change was passed on to them as well.
Yes, we didn't see any dropping off of the commitment to reform. Crown today is a very different business to the one it was before the Bergen inquiry, no doubt about that. and the early signs after the Bergen, they got it after Bergen's report was issued. Those people running the company realised the urgency and the seriousness of the whole issue, and they worked very quickly, and we didn't notice any discernible drop-off in enthusiasm or a cooperation after Blackstone took over. They got it as well. They're an experienced owner of casinos, so they know what's expected, and they've behaved very impeccably as well in terms of understanding a business-like approach and working with the regulator. Very important.
So what does the announcement today actually mean for Crown Sydney?
So its licence is no longer suspended. Its licence has been restored to it. Its casino licence in New South Wales, and importantly, Crown Resorts has been found suitable to be a close associate of Crown Sydney. So it can operate, but now it's of course subject to all of the requirements that were imposed on it by way of the internal control measures which govern how they operate.
Now, Crown is very different to what's happening at the Star, which is obviously the elephant in the room here. Is there anything over the past few years that Crown have done really well that the Star can potentially have learned from?
That's probably right, but I don't want to comment today because the Bell inquiry is continuing. The hearings are happening today. It's not appropriate for me to comment on the Star while ever those hearings are continuing and before Bell writes his report. He's reviewing. There are private hearings, there's public hearings. He's going to review all of the evidence and he will provide us with a report. And at that time, I will have something to say, but at the moment, that's not really appropriate.
Part of your role is probity, correct? So say, for example, if the Star were to lose their licence to operate in Darling Harbour and Blackstone were interested in taking over that asset, would you then need to step in and do a probity check on the viability of Blackstone owning 2 casinos in Sydney?
So I don't want to talk about that eventuality because it's not one that is realistic or has even been discussed. If anyone comes along to buy or make a bid for either of the casinos, then we need to do due diligence on the bidder and to be satisfied about their probity, no matter who they are. So there will be a process for any bids made, whether it be Crown or the Star.
Later this year, the Star's going cashless. What impact's that going to have on the potential weeding out of money laundering within the casinos?
Look, I think cashless is a really good development for 2 things. One is the casinos understanding who their customers are and then limiting the potential and the ability to launder money. So the key to it is, in my view, is it's like introducing any new system. They need to ensure that there is if you like, an education piece with their patrons so everyone knows it's coming. They work with their patrons to minimise the business shock that might occur if people have suddenly realised the casino's converted to cashless and they're not ready for it. So, but I think it's a very important tool in the sense of making sure that people don't launder money and that the casino understands who their patrons are.
The work you've done bringing Crown Sydney up to the level it is today, where they can operate their casino by themselves, has generated global headlines. What other regulators around the world have been interested in your systems and processes?
Well, we're part of a number of international bodies of casino regulators, and they've expressed enormous interest in the way we've approached the problems that were watched very carefully. There was intense interest in the Bergen inquiry, and there was intense interest in the Bell inquiries to the sort of problems that arose. And all regulators around the world look very carefully as to how those problems arose and what they need to do to make sure they don't arise in their jurisdiction. And included in that is understanding what we're doing in terms of imposition of rules that govern how they operate. So there'll be conferences coming up where we'll be later in the year, I think, October. So they're important conferences for us to get to as and when we can.
Philip Crawford, NICC Commissioner, thanks for your time today.
Okay, thanks Ed, all the best.
The Department of Infrastructure and Transport, along with the National Transport Commission, are working to update Australia's road rules to ensure autonomous vehicles can operate safely on public streets. The industry is working closely with federal and state governments and peak bodies to improve our regulations, but the process will take time. I spoke to a leading academic, a key industry group and the insurance sector to understand how Australia is tracking. Believe it or not, Australia is the world's biggest success story when it comes to autonomous vehicles. But they aren't on public roads. Mining giant Rio Tinto has successfully used autonomous haul trucks, drills and trains for many years in the Pilbara on its iron ore mines and railways. But when it comes to passenger vehicles on public roads, Australia is in the infant stages.
I think, consumers are waiting for these vehicles to come, but we also need to keep in mind that it's not a straightforward process. Driving autonomously in busy urban environments is not a straightforward solution to problem to solve. So there's activities happening. Industry is working really hard to solve that problem, but they're not going to be here tomorrow.
Autonomous vehicles like robo-taxis are already operating on public roads in parts of the United States, and they're being tested in Europe. Hopping into one and taking a trip can be a bit unnerving. But how do they work?
There's really two things to know about a robot car. There's the hardware on the car. You'll see all these sensors on a car, like a camera or a laser that tells it about what's around the car. And then there's the brains, or what most people would call the AI, or artificial intelligence, that runs on the car. And that helps the car think about what it's seeing, helps it make the right decisions about how to go from point A to point B, and be safe in how it drives around the city.
If you buy a new car today from any showroom, chances are it's already loaded up with plenty of advanced technology and driver aids. But our current road rules state that you must always keep your hand on the steering wheel.
We've already got a lot of automated features in our vehicles. So if you buy a new car today, you might have the privilege of having adaptive cruise control, lane keeping technologies, a range of features, autonomous electronic braking, that help you navigate through a busy urban environment, or more on a motorway environment as well. So it's step by step as we work through these processes.
This week, the Department of Infrastructure and the National Transport Commission called for public feedback on a proposed regulatory framework which would eventually change the road rules to allow for autonomous vehicles. The legislation has entered a public consultation period until the 11th of June. Experts say the process is going to take time.
At the moment, the driver has to be in charge of the vehicle, so that's the regulatory framework that we've got in place for safety in Australia at the moment. The next step is working through this regulatory process, and within a couple of years that's expected to be in place, and then it's really up to industry to make those vehicles available in Australia.
In Australia, several companies have held trials and pilot studies with driverless vehicles on Aussie roads. But these new laws will eventually allow autonomous vehicles to operate like they do in places like San Francisco.
The technology is most of the way there, and that's why if you go to places like San Francisco, you can do what you just said. You can get in a robo-taxi and have it take you from point A to point B. In Australia, we've caught up a lot. The regulations are being updated pretty rapidly. And so I think we're in a much better place than we were, say, 5 years ago for introducing technologies like autonomous vehicles. The big challenge is you need a big player in the field, one of the big companies that are operating these robotaxis, to really want to come and test them and deploy them in Australia. And the amount of interest there has been relatively limited to date.
Another big issue for the sector is understanding the liability if a driverless car is involved in an accident. Who's at fault? Is it the passenger, the car maker, or the company which built the technology? It's something the insurance industry is grappling with.
From an insurer's perspective, what's critical is gaining the data and the insights as to how these vehicles are performing. Because with that data, we can start to price the liability and the cost of underwriting and sharing the risk of these types of operations. And it really is a whole new world. This is a world where technology comes together with ethics, understanding how driverless vehicles make decisions.
Earlier this month, electric vehicle giant Tesla settled a lawsuit in the United States over a crash in 2018, where a man was killed while his Tesla Model X was operating on autopilot. The case did not go to trial,
which has prevented the question of liability being tested through the American court system.
There's the driver, there's the owner of the car, there's the people or the manufacturer of the car who ultimately is responsible. We haven't had a large number, I guess thankfully, of court cases around tragic incidents with autonomous vehicles to date. Some of those will set some precedent, but I imagine it will be a pretty rapidly evolving field, and it's going to vary, I think, from country to country as well.
For insurers in Australia, it's a case of observing what's happening overseas and learning from it. But the problem is, despite these cars being safer, the insurance costs to repair these complex vehicles continue to rise.
People still make mistakes when they're driving. They're better protected in those vehicles. They are safer vehicles. But the cost of repairing them has actually gone up because they're very technical pieces of equipment these days with a lot of sensors and the like built into them. So ironically, they're safer cars. We are still having the same number of accidents, and it's costing more to repair them.
After the break, we'll take you to Singapore, where our reporter Steph Nash recently caught up with the US tech giant Oracle, which is in the process of rolling out a range of artificial intelligence services for its customers. Welcome back. US tech behemoth Oracle is gathering momentum in the artificial intelligence space. The company, which is close to a market cap of $500 billion Aussie dollars, is in the process of rolling out a range of generative AI services for its extensive cloud customer base. It makes Oracle a good authority on how and why businesses are deploying AI technologies and how they're adapting in these challenging times. Last week, Oracle's roving Cloud World Tour arrived in Singapore to bring customers together from across the Asia-Pacific region. The company announced that as part of its investment in the future of AI, it would be collaborating with the Singapore government to offer up to 10,000 training places for students and young professionals. Our reporter Steph Nash attended the conference as a guest of Oracle and spoke with Oracle executive Gary Miller.
Yeah, so there is a pretty drastic skills gap, around the world with our customers, our partners, and our employees. And so we take it very seriously that we need to really raise the tide of the knowledge and training and certification and experience for everyone, especially, from a social responsibility perspective as well. We look at we think it's very important to bring, young people into the technology to get them empowered so that they can build their careers. We're very happy that many people around the world have built their careers on Oracle technology. So the more we invest from a social responsibility perspective, the more we see that as benefiting Oracle in the long run. But it's really about, there's a huge gap. We need so many more people who've got those AI skills, and so we're investing to make that happen.
We've spoken with a few big tech players who say they think we're on the brink of the next industrial revolution. What do you think about that? How do you think AI is going to transform the way we do business?
It's exploding. What we're seeing is, we've had a lot of customers, they've moved to our application cloud or to our cloud infrastructure. And we're seeing so many customers experimenting with AI. Some customers have a very thought through AI strategy, others don't. And so we're seeing people, are able to do things in a couple of weeks. We had one company that, their business challenge was they would have a lot of products that were delivered to them, and then they would have, online shopping. And they said, we get a lot of damaged goods come, and it's very hard for us to manage that and return it back. We built an AI solution with them in 2 weeks, which could identify damaged boxes. And with 99.9% accuracy, we were able to store that in our vector database. So you could do searches on, show me the damaged boxes of this dimension that were 3% damaged. That was in our vector database. And then we completely automated the return process, which would see which country the box came from and would return it using the language of where it came from. And that was all done in 2 to 3 weeks using standard AI components. And so the value they saw there was enormous. So I think the industrial revolution piece of this is customers can get time to value very quickly and can get the skills to do it very quickly. and can see, orders of magnitude, cost savings or revenue increase or productivity increase. So that's, I think, where the excitement is. The challenge is there's so many things going on. It's hard to keep on top of it and share those with other customers and with other partners. So it's the pace that this is happening is absolutely mind-blowing.
And how are your customers using AI? What would you say is the main motivation? Is it, about trying to streamline, trying to, realise greater productivity gains?
Yeah, so there are a few trends. One is not replacing people, but making people more effective. So if you look at these, the 52 enhancements we made to our AI enhancements to our applications. So one is, if somebody's writing a job description for posting, in the past they would, write it all out. Now that you say, you can go in, you can generate the posting, say, write me a job description for an AI developer and a data scientist. It gives you the first pass, and then you can look at that, modify it, and then you can say post it. Post it in the recruiting system. So I think the first wave is how do you make people more efficient and actually, higher quality output. So that's one wave, and again, how we're addressing that with is embedding in the applications. And then we're seeing people who are really trying to do completely breakthrough capabilities where they want to mix video data with structured data, which again we can do in our vector database, and then kind of roving edge where we have customers that have drones that are collecting video data, and right at the edge they're saying, well, I don't need to send all that data into the center. I'm going to use AI to actually just send the important data. So it's allowing people to look at, create completely new processes. So some of it is making people more efficient, and others is complete breakthrough solutions that we've never even seen before.
We also know companies are using AI to innovate. What are some of the things you've helped your customers achieve?
Well, I'll give you Red Bull as an example. So, Red Bull racing is the the racing, the Formula One piece of that. But they also have other businesses, and one of them is they're designing a new engine. And they're actually using our AI tools to model what's going on in that engine. They're going to be able to develop a brand new Formula One racing engine in a time frame that's unheard of, and they're using AI technology to help with that.
Gary, what are some of the challenges of managing the large-scale infrastructure projects that you have at Oracle? For example, data centres, they have all sorts of issues, including sustainability. They're large energy users. And as critical infrastructure, they're also subject to cyber attacks and cyber safety. Tell me a bit about how you manage those challenges.
So the first is we have sustainability goals, so we're trying to be carbon, meet our carbon goals. So whenever we build a new data center or we go into an existing data center, they have to, meet very tough standards for us from a sustainability perspective. And customers are asking for that. How sustainable are your data centers? The other is because our cloud is kind of a Gen 2, it's much more efficient. So for the actual output versus the power consumption, we have a very good ratio there. Things that might take a certain time on the existing cloud can be done much faster on ours, so you consume less power to do that, less cooling. So I think from a sustainability perspective, we have very clear strategy on that. In terms of the actual cyber threat and things like that. Again, Oracle started, our heritage was building systems for secret service, organizations around the world. So security is fundamental to everything we do. And if you look in our cloud infrastructure, there's embedded security at every single layer. Part of our, the Generation 2 cloud is that the customer data runs on a completely different network than what the Oracle system to manage it is. In other clouds, that's all intermingled. So we don't actually, if somebody gets into the way we manage cloud, they can still not get to the customer data. So that's an example of how we've architected our cloud to be highly secure. And then we use many, many tools looking at things to make sure that there isn't Bitcoin mining going on or malware, et cetera. So, we believe that, if you move your things to our cloud, it's going to be much safer than if you kept it in your own data center.
Oracle has special relationships with Microsoft and NVIDIA. How important are these strategic partnerships for your customers?
So I think, again, we're really driven by our customers, and our customers said they didn't, they wanted to put the workloads where it made most sense. So we've always been open. Oracle's always been a very open company. Our databases run on everyone's technologies. So we had, we did have relationships with Microsoft, and again, we basically said, let's work together to meet our customers' needs. So we've put a huge effort with Microsoft to just continually increase the level of interaction. First, it was just connecting the data centers, with basically a network. Then it was, from the Azure being able to start up services or Oracle services, so the customer doesn't even need. Now we're even installing our dedicated cloud region inside an Azure data center. So, again, the partnership is really important so that we can solve our joint customers' needs. And we're open to that with any cloud provider, but Microsoft's been a great partner there. With NVIDIA, it's been a long-term relationship where, again, we've been working together. How do we bring their GPU processing to our clients? Again, the way OCI was architected, and with some of our database technology, we were able to plug the GPU processors into OCI in a very, very efficient way. Again, but the partnership with NVIDIA was what made that work. We worked very closely to make sure there's a lot of synergy there. In the end, you have to pick. Picking partners is very important, and picking the right ones is very important. And so, we were very, very happy about the partnership with Microsoft and NVIDIA.
Finally, Gary, as CSO, you'd be hearing a lot about what your customers are thinking in terms of the future. What do you think the outlook is for your customers? Are they worried?
There's a lot going on in the geopolitical environment at the moment, and again, there's inflation, there are many things. But so I think, most of the customers we talk to, they're just looking at, how do I become more efficient? How do I do more with less? So we don't necessarily hear, of fear, but it's really the conversation we're having with them is, how can you help me be more efficient? How can you help me save costs? How can you help me, create new revenue streams? So it's back to kind of basics we're hearing. So I think, we all came out of COVID. There was a lot of innovation in COVID, and now, the world has moved on. So I think it's and every customer is different as well. I think the competitive pressure is higher. I think there's new entrants into financial services. So existing banks are like, how do I react with that? Telcos, the cost of providing mobile, telephony, is always being driven down. So, but those pressures have always been there, I think. So it's more about back to the basics of how customers are saying, help me be successful, be more profitable, be more resilient. How can you help me do more with less? So that's what we're hearing.
Gary Miller, thank you very much for your time.
It's been a pleasure. Thank you.
That's all for the show this Sunday. Up next is all the latest news right here on Sky News. Business Weekend return next Sunday, but don't forget, you can keep up with all the latest business news with our daily program Business Now at 4:30 p.m. Eastern Standard Time. Thanks for your company. I'm Edward Boyd. We'll see you next week.